Oh, yeah. First live of the year. Such an exciting time. It sets the tone, it sets the pace for the new year. Just waiting for a few more people to catch us. We're getting started right now. It's about 4:33. Hey, I'm Mitch Goldberg. Thank you so much for joining me. Welcome to a brand new episode of Be the Boss of Your Money. It's our first episode of 2022. Happy and healthy new year to all of you. You're going to have such a good year. I have learned so much about running a show about personal finance, investing, education. I've learned so much over the last 2+ years of doing this live stream, and I'm using all of that information, all of the lessons to really step it up this year. So I'm really pumped. Today, we're talking about the market. The market continues its winning ways of 2021 into 2022. So we've got a couple things, Apple, Tesla. Here we go. Let's roll the quick intro and get into it. Here we go. Hey, thank you for joining me. My name is Mitch Goldberg. You're watching my live stream. It's called Be the Boss of Your Money. A little hokey, a little corny, but it's all about giving you the education you need. I've got over 30 years of experience as a financial advisor working directly with clients, with retail clients, people like you, the people who are watching this show right now. And I take all of those years, decades of experience, I put it together and I just come up with stuff to teach you, save you a lot of trial and error. And I really want you to be confident about your financial future and the steps you're taking to help you get to your financial future. So, we're going to talk about a lot of things this year, but I can't believe that I started doing the daily like we do now almost daily. I do this every Monday through Thursday at 4:30, but I started doing the live stream in October of 2019, getting it set up, just finding my way like everybody else. And then around early 2020, I started doing pop-up live streams when the stock market would have like one of these crazy days, limit down. Um, this weird virus, a coronavirus, some kind of weird virus was affecting some people in California and some people getting spooked out. And then by the time we got to February of 2020, we knew we had a problem on our hands. And by the time we got to March, the World Health Organization, March of 2020, declared the coronavirus COVID a global pandemic. It was a really weird, freaky time, something that basically no one alive has ever experienced. There is one woman in Italy who survived the Spanish flu and COVID. Isn't that incredible? I think it's probably just one person in the whole world, right? Uh, anyway, I started doing this pop-ups in February, and by the time we got to March of 2020, I'm like, you know what? I'm just making this a live stream. And then everybody had to go home. Like the whole country was shut down. Everybody had to go home. And I decided I'm going to keep doing this daily because people are going to have nothing to do except look at their screens all day. And I haven't changed. It's just, I've made the show a lot better. I've got better cameras, better technology, better audio, better visual, um, better graphics. At the time we were locked down, so I was doing a lot of live streaming from my home, and now I'm doing this from my office. And I love doing this. I love teaching. I love sharing knowledge. I love learning too, by the way. So if you've got some words of wisdom, hit me up in the comments if you have any questions about what we're talking about. And I say what we're talking about because I'd rather this be a conversation between you and I as opposed to just me lecturing. I don't want to lecture. I want to talk to you like we're friends. We are friends. I just want to have a conversation, right? So if you have any questions, hit me up in the comments. And that is the best part. I love talking to you, giving you answers, the shout outs, the wisecracks. It's all part of the fun, especially with the wisecracks. So be the boss of your money. It's about helping you take control of your money. That's why I call it be the boss of your money. You've got to kick your money around. Show no mercy to your money. Your money is not your family member. It's not your pet. Your money is an inanimate object that is a tool, and you work your tools hard to build what you want. I'm just like chock full of new analogies and metaphors in 2022. So I want to start by giving you my very, very big market forecast for the year. My market forecast, my prediction for 2021 is that the stock market goes up almost 27% as measured by the S&P 500. Ooh, I know it's 2022. You're thinking, did Mitch lose his mind? No. I mean, I could give you my stock market prediction for 2021. It's easy, 27%. By the way, the S&P 500 is an index. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. But yeah, 27%. Oh, you want to know what I think for 2022? Oh, you want me to tell you what the stock market's going to do for this year that just started? Today's the first Monday, the first day that the stock market is open in 2022. So I'm going to tell you what the market's going to do this year. It's going to go up, sideways, or down. Now, seriously, I'm not trying to be a wise guy. I don't know. I mean, I have my thoughts. I could give you the reasons why the market could continue to go up. I can give you the reasons why the market could go down. I could give you the reasons why we'll just continue to have a tug of war between the positive reasons and the negative reasons. Just a tug of war that seems to even out investors. I don't want to get into the guessing game. I mean, if the market is up 10% in 2022, if it's up 20%, 25%. There's going to be somebody who said, I predicted the market would be up 25% in 2022. And that person will get accolades. They'll be all over TV. But there's as many investors as there are, that's how many people are offering up a forecast for 2022. Except the smartest investors. The smartest investors are not really concerned about what the market does this year. We'll get into that in a moment. But there's so many people calling you making predictions. So somebody's bound to be right, and that person will take the mantle of being right for that particular year. It doesn't really help you. Now, the smart investors, they are investing for the long term. One thing I want to say is people trade themselves too much. We've talked about that recently on this show. People think they're controlling their risk or they're controlling their downside. They're limiting their downside by trading, by making some buys. And so they're taking control of things. That is an illusion, that you're taking control of things, because the hard thing about investing is you are ceding control to the unknown. You're just like, I'm going to put my hard-earned money into something that I don't know how it's going to turn out. This is why investors like bonds. You buy a bond, you put, X amount, you put $10,000 into a bond that matures in 5 years. In 5 years, you're getting your $10,000 back plus whatever interest the bond gave you. Now, if the bond is only paying, let's say 0.75% and inflation is 6%, well, you might think, well, I'm getting my principal back at the end, so I'm not losing money. But at 6% inflation, it's like you're getting back less money because you're not keeping up with purchasing power, right? Because of inflation. But that's a story for another day. Preservation of capital does not mean you stayed flat. Preservation of capital means you are ignoring inflation so you could have the same dollar amount from now at the start to the end, to the time when your goal comes up. And if your goal is very far in the future, if you want to preserve $100,000 for a goal that's 20 years from now, that's going to cost $100,000, great. But, you're losing money to inflation. So inflation is even 1%, you're going to lose, like a lot of money, over 20% of your money. So in terms of buying power. So that's how inflation works. I hope I'm making sense to you. Okay. So that's what preservation is. It's just about saying I'm starting at point A with X amount of dollars. When I get to point Z, I'm going to have the same exact amount of dollars. I know what I'm going to have at the end. And that's fine. If your goal is 3 months, 6 months, 9 months, a year, even 2 years out, that is a good strategy. Preservation of capital. Your goal is 5 years, 10 years, 15 years out or more. Well, maybe it's not such a good goal. An emergency fund should be preservation of capital for sure, because you never know when you're going to need it. You might need it in 5 minutes. You may never need it. Hopefully, you will always look back and say, I should have invested my emergency money. That would be a great thing because it means you never had an emergency, because it would mean you never had an emergency need for that money. How lucky. How lucky. It's like insurance. Hopefully, you will never need your insurance. Hopefully, your insurance is a waste of money, right? Because it means you didn't have a problem. All right. Um, so that's how we talk about preservation. And if you need your money in, let's say, 2 years, 3 years, 4 years, then it's debatable if you should invest that money or leave the money as preservation. Leave it in something very stable like a cash equivalents, like a savings account or a money market or a CD. That really is more a matter of how much risk do you want to take with that money. To me, if you know you have a big need in a few years, it's substantial. Cash is a good place for that money. Preservation is a good place for that money. Okay, so we digress. Let me just take a look at who is out there so far. We've got Stacy out there. Stacy, thank you so much. And by the way, Stacy, thank you for being such a great, awesome, amazing, phenomenal supporter of my live stream effort. I really appreciate it. You were always there, and I always see your name out there, and I want you to know I notice it, and I appreciate it. It means a lot. I see Michael Haltman is out there. Hey, Mike, good to see you. Michael, I know you've been doing live streaming, and you're converting to strictly a podcast, and I look forward to listening to your podcast and seeing how you do on your journey. And I know it's going to be a lot of fun for you. Okay, so we're talking about what the hell were we talking about? Let's talk about more stuff. Actually, what we're talking about, I feel like we're just going to be repeating it. So I have a new place to go. Let's talk about something called the January effect. This is a big deal, and it's talked about. And the January effect could be a pretty substantial market moving phenomenon. Phenomenon. Okay. The January effect could be a pretty big phenomenon for investors. And what I want to say about the January effect is it's a short-term phenomenon. What it means is that you have stocks that have done poorly in a given year. And some stocks, let's say, have gone down a lot. And now investors are selling those down stocks because they want tax losses. They want to dump those stocks. On the other hand, stocks that are up a lot, investors are like, well, I'm up, 100% in a stock or 200% in a stock. It's December. I'll just wait a month to sell it, wait till January, because at least I'll put off the capital gains tax for another year. Maybe right now it's a short-term capital gains tax, but if I wait a little bit longer, it'll be a long-term capital gains. But basically, people hold on to their winners, especially money managers, the professionals, institutional investors, hedge funds, mutual fund managers, active managers. They want to hold on to their winners because they want you to see that they had these winners on the books. When you get your year-end reports from all your fund managers, and you say, oh, they all had they had an Nvidia and Google and Microsoft and Apple and all the other big winners, right? They don't want you to see that they lost money on Zoom or Moderna or DoorDash. They don't want you to see that. And they might be looking for a tax loss. And retail investors like you and I, we could be looking for a tax loss, right? So you sell the losers, you hold on to the winners, or you buy more of the winners. Window dressing for institutional investors means they'll take money from the losers that they sold. They'll put that money, reinvest into winners to look like they have more of the winners on their books. That also has the effect of pushing winners up to higher highs. Okay, so then you get to January. The calendar turns December 31st. Yay, Happy New Year. Okay. Happy New Year. All right. Little party background, applause. So you get to the new year, and what happens? People decide, I've waited to take my gains to put off capital gains for another year. Well, now we're into January. So maybe not the first day of the new year, but sometime early in the year, you know what? Maybe I'll sell some of those big winners that I have. Why sell a big winner 2 weeks before the end of the year when you could sell it 2 weeks later and put off the capital gains for a whole year, right? On the other hand, what about the losers, the stocks that got crushed? So people are selling those. They're just hitting the bids. They're just slamming those stocks, kicking them out of their portfolios. Sell button, sell button, sell button, sell button. But you get to January now. Well, there's no need really for an immediate tax loss. So investors stop selling those stocks. So if you have activity in a stock, there's always sellers, there's always buyers. If the sellers overwhelm the buyers, the stock goes down. But all of a sudden, the selling stops. So now you have buyers left. So now the buyers, it flips. The buyers start to overwhelm the sellers. So the down stocks, the downtrodden, the beat up stuff lifts, has a rally just because there's no more selling pressure keeping a weight on the stock price. Stock goes up. The winners, on the other hand, there's nothing pushing them up anymore at the moment. I'm not saying nothing, but the impetus to hold on to these and buy more of these kind of it goes away when you turn it to January. So those stocks then go down because the buying slows down, the buying pressure, the buying power is reduced. And then you have, even if the selling pressure remains the same, but the buying power is reduced, these stocks go down. So you get a little bit of a flip. And that more or less is the January effect. Is it worth anything to you? I think it's not worth much more than the Santa Claus rally that we always talk about. The Santa Claus rally, we've talked about that on the show, where it means stocks have a tendency to rise during a 7-day stretch of the last 5 days of the previous year and the first 2 days of the new year. And we've been getting a nice Santa rally, which has continued today. Tomorrow is the last day of that 7-day stretch. Tomorrow, January 4th. So, is it worth trading? You should know about this because you hear so much about it. Let me say a few things about this. I don't think it's worth making changes to your portfolio just for this. If you think you want to jump into a stock that's down in 2021 and jump on it early 2022 because you think there's a buyable or a tradable bounce, then go right ahead. You want to trade? There's nothing wrong with it. Have fun. Okay. By the way, I'm not one of these people who say, "Oh, trading is bad." Oh, we're very conservative. I'm so conservative. I find when financial advisors just tout how conservative they are, we're very conservative. We're super. We never do. Oh, conservative. They don't want to do anything. No risk at all. I find that either the financial advisor thinks that they're going to attract a certain kind of client who is a scaredy cat. So you're trying to attract a certain kind of client. It's like a really bad marketing ploy, right? Or a financial advisor does that works for a firm that doesn't actually allow the financial advisor to do anything. The financial advisor, the firm says you could be an asset gatherer. You could put your client's money in the investments that we tell you to put them into, these particular portfolio mixes, and that's all you're allowed to do. But they're not allowed to do anything else. They can't do any social media marketing. They can't do a live stream. They can't They can't do anything, and it's not because they even want to. They'll say it's just because we're very conservative, so we don't do that stuff. That's like it's like a really dumb thing to say. You're not allowed to do anything. So instead of saying you're not allowed to do anything, you say, "Oh, I'm allowed to do it, really, but I'm just being conservative." Yeah, okay. I know the industry. Look, I've been in the industry for over 30 years. Okay. Anyway, we're talking about the January effect, and I think it's a pretty cool phenomena. It happens a lot. Josh is out there. Hey, man, thank you very much. And oh yeah, thank you for the emojis. I like those. The love eyes and the starry eyes. Did you change your picture there on YouTube there? Okay. Um, Good pick of you, buddy. So, and we've got a few more people out there, and I really appreciate that. Okay, I appreciate all of you watching this. So, so here's the thing with my conclusion on the January effect. Okay, the winners didn't go down. The winners of the previous year didn't go down. Okay, because they turn into bad companies. They typically could have a little bit of a hiccup, a minor hiccup. I'm talking small, 1 to 5%, maybe less, maybe more. Okay, it depends. You have to take this on a case by case, stock by stock basis. But the winners, the quality, the ones that investors want, they just get back to their winning ways. As you can see, Apple today, if you don't know this, Apple reached a new stock market historical milestone. Apple today reached the $3 trillion market cap. This is the first time we've ever seen a company with a value of $3 trillion. It boggles the mind, but only about 4 years ago, less than 4 years ago, Apple hit a $1 trillion market cap, and people were like, that's insane. No company should ever be worth that much. Then about a year and a half ago, maybe, was it? They hit a $2 trillion market cap, and now a $3 trillion market cap. But the company's fortunes are doing better. They're doing better fundamentally. Earnings, revenues, okay, products, units, average selling price. Okay, they're doing all of these things. They're selling crazy amount of those expensive AirPods that my kids like to buy. I buy the cheap imitation ones for $29. Speaking of kids with AirPods, we have Jesse. Hi, Daddy. It's Jess and Benji. Oh, Benji's watching too. That is so cute. Benji's our dog. You want to see a picture of our dog? I'll give you a picture of Benji. I might be able to. Here he is. Oh, isn't he cute, my little puppy dog? That's Benji the Cavapoo. Okay. That's like your special treat today from me. Okay. I love going home and Benji's all over me. He's just the best, the cutest. So, and Ree is out there. Hey, Rianne, how are you? Nice to see you. Hope you're having a good vacation, by the way. So, the January effect. I'm going to end it right here with this. The January effect does not turn quality companies into bad companies just because the calendar changed. And I want you to be aware of the January effect in this regard. It does not turn crap companies or crappy stocks into quality stocks. The selling pressure is reduced, so a stock that has been pummeled could recover a little bit. But if they were overpriced the end of the year, 2 or 3 days has not changed the fortunes or business plan or fundamentals of a company. So just because it goes up doesn't mean all of a sudden, now it's a good stock. Now it's going up. It's just the January effect. And then the crappy stuff goes back to being crappy stuff. People who bought it for the buyable bounce and didn't get out realize that. They learn the hard way again and again and again. And the people who decide they're going to average down by the dip in these stocks, and this somehow justifies it, that they're up from the January effect. And then they realize, wait a minute, nothing's really changed. If you're overpriced and the fundamentals of the company just don't add up to the stock price, it's not worth it's not worth buying. Okay. If anything, you want to buy the good stuff when it dips from the January effect, as opposed to buying the junk that goes up. Okay. No junk in the trunk. All right. So that's enough about the January effect. I thought it was worthwhile talking, not for as long as we did, but we hit Apple and Tesla. So Tesla sold, uh, Tesla, excuse me, these are the vagaries of live streaming. Tesla sold almost 1 million cars last year. The stock is up like $75. So we're just getting back to the winning ways of 2021. Not much has changed. The things that are pushing up stocks right now are a Fed that's very communicative and moving very gingerly, being very stable. If you think the Fed is behind the curve of inflation or not, they're not looking to spook investors. They're looking to really be ahead of the curve in terms of their communication. Omicron is everywhere. I'm having trouble thinking of any family that my wife and I know where there's not somebody in the house who doesn't currently have COVID. I mean, my kids' friends, there's so many of the friends have COVID, so many adults, have COVID. It's all over the place. But the hospitalizations, they're going up because just the sheer numbers. If a tiny percentage of people who get Omicron need hospitalization, the point is if there's so many people, even though it's a small percentage of people, if there's so many people who contract Omicron, it's still going to be a lot of people. So we have to follow that. There are hospital systems all over Rhode Island, Michigan, all over the place that are really having a tough time keeping up with demand for health services because of COVID admission. So hopefully this will turn the corner in another couple of weeks. We'll say we peaked, right? January is the peak, a lot of experts are saying, and then we start to go down with cases. All right. So the market's back to its winning ways, and we continue to focus on quality here. I mean, I like to say this is a show where we leave the bullshit out. Okay. We're not about fluff. We're not about showmanship. Obviously, we're not about showmanship. I'm not the most exciting person to watch. Let's just take a quick look at how the major averages did today. Pop myself up in the corner, and then we'll end it on that. But the Dow hit a new record, 36,000 and change, up 246 points. NASDAQ up, S&P is up. Gold almost back to 1,800. We always talk about this. Gold just has a trouble with 1,800. The worst thing for gold and the worst thing for crypto is a Federal Reserve that has gotten religion, that has gotten the message that they have to be careful, rein in the dollar supply, rein in their loose monetary policies, and start to raise rates and scale back on other monetary policies like quantitative easing, like bond buying. That's the worst thing for gold and cryptocurrency. Gold, we talked about gold. Oil, 76. It's inching up pretty solidly. I wouldn't be surprised to see oil back in the 80s. There's some forecasts just for 100. It's not so much that anyone did anything wrong. There's enough blame to go around. Politically speaking, for the price of oil, demand is up. And even though you see battery operated cars popping up everywhere, a la Tesla, and they're doing even battery operated cars are doing even better in Asia and Europe. But there's still more cars on the road, so there's still going to be more combustion engines on the road. In any event, we talk about the VIX a lot. The VIX is back to the 16s. I always tell you, under 20 we rally, over 20 we sink in the stock market. VIX under 20 it rallies. Follow that closely. That's really very predictable. All right. And lastly, let's take a look at the Rus 2K, up 1.21%. Overall, pretty solid day for stocks. The crypto world, see, cryptos are down. Why are cryptos down? Again, crypto has been sinking for a while. Last week, it did really badly. Crypto continues to go down because the worst thing for crypto is a responsible Federal Reserve that got religion. Okay. That got the message that inflation is too high. There's too much money printing. And all of a sudden, the Federal Reserve decides to be more responsible, meaning more grown up, tighter fiscal policy. The whole point that people were touting crypto is that the central banks of the world have become, over printers of their currencies in order to stimulate the economy. Well, they stimulated the economy globally, and we have inflation, and all of a sudden they're getting responsible. So that's what that is. Let's just take a quick look at the 10-year Treasury. I should have gotten into this real quick. Let's just the 10-year. So listen, the 10-year yield jumped to the 1.6s. It was in the 1.4s before Christmas. It's in the 1.6s now. Okay, back to the cryptos. The cryptos just not doing well. And I always have to look at the joke of Dogecoin. Doji down 17 cents. But cryptos overall were pummeled, and Bitcoin, the leading one, down almost 2%, continues to just go down. Let's take a look at the industrials. Okay. Airline related, Southwest up to 44. You could have had that in the high 30s as a bargain as much as a week and a half ago. Boeing. Part of the reason Boeing is up is the January effect, by the way. There's just no more selling on it because anyone who wanted to bail out and take a tax loss has probably done so already. Boeing is also expected to become a good fundamental story because they're now able to sell their aircraft. Their Max series has gotten recertified. So that is a huge positive for a giant like Boeing. And when Boeing is running on all cylinders, Boeing in and of itself stimulates the entire economy because Boeing is such a gigantic manufacturer and typically the biggest exporter in the country. Okay, so let's take a look at some other places that we need to take a look at. Let's see in the tech space. PayPal, that's part of the January effect, but down from 310. Logitech, a lot of the stuff was down. DocuSign was down. Okay, also now not everything's up just because of that. Micron, Nvidia, Apple, they continue to do well. So not everything is just the January effect. Maybe Nvidia a little bit of the January effect. Let's take a look at the sectors of the winners today. Energy and real estate were the biggest winners last year. Energy continues to rally this year. Consumer discretionary, financials had a good day. Tech had a good day. Industrials a little weak. Healthcare a little weak. Building materials, which had a really good year, were a little weak. But this is just day-to-day stuff, and this whole January effect stuff will probably be over by Friday. Today's Monday, so it's a short-term thing. Anyway, that's the that's my story today. I'm gonna put my social media emoji things back here. You see these thingies here, the social media thingies. So I post all the time on Instagram, YouTube, obviously, LinkedIn, Facebook, Twitter. I'm posting some other stuff too besides just video and video highlights. I posted something I thought was kind of funny on Instagram and LinkedIn. I'll share it in more places, maybe tonight or tomorrow, but take a look for that. And I'm just want to thank you. Thank you for making this so much fun. And I'm so happy to go on this wild ride with you. I'm going to end the show now. I should be back tomorrow, and have a very good night.